Let's talk about it all with Ed Yardeni. He is president of Yardeni Research. I love the optimism. Ed, you think it's possible we just let the good times roll right into the 2030s?
Well, look, Brian, I think the economy just demonstrated its resilience, right? Over the past 3 years, we've had the most widely anticipated recession of all times that didn't happen. It was a no-show recession. And I think it demonstrated that even with the Fed raising interest rates aggressively, with some of the geopolitical issues that challenged the global economy, and despite all that, the economy grew. There was no recession. And I think we have to kind of take that into consideration, that maybe this economy really is resilient. We just had some upward revisions in the labor market that showed that the labor market has actually been very strong and resilient. Unemployment rate remains around 4%. So far, so good.
But here's the dirty secret. We're learning this in Germany, right? And the German economy is not good. Costs are higher, but their stock market is well outperforming ours this year. Can show the disconnect between economies and stock markets. So if our economy, Ed, remains strong, and we all hope it does that necessarily mean the stock market will also remain strong?
Well, Germany has a lot of conflicting developments. Their economy looks pretty weak. They're competing with China. China's literally eating their lunch when it comes to car production. So they've also got a really messed up transition from fossil fuels to clean energy. We have our own challenges, but overall the economy is doing extremely well. And I think it's going to generate earnings that will drive the market higher. I wouldn't really want to see the market go higher on valuation because valuation is already stretched. But I think valuations at current levels actually can be justified if investors are kind of looking at the economy the way I am, and that is it's just proved its resilience. Why can't it continue to be resilient and grow? And if that's the case, we could be looking at a fairly long period of economic growth, earnings growth, and that's good for the market.
Ed, that was going to be exactly my question. The pushback that I hear from people is not about the stock market broadly, because you can look around and say, look, there's things happening in AI, there's innovation, but it's about the Mag 7 in particular, whose valuation isn't that wild, but they just think, everyone's in one boat. They're in the S&P 500, they're in the mega caps. There's no more buyers left, and, we're going to mean revert, and we started to see that in January.
Well, look, I have really no problem with this concentration issue that people are worrying about, that there's, the Magnificent Seven account for 30% of the market cap of the S&P 500. There's lots of other stock markets around the world where a handful of companies really account for most of the market cap of their markets. In our situation, these are credible companies. I mean, they don't have a lot of debt. They're generating a lot of cash flow. They are able to buy smaller companies with the technologies that they can leverage up and make them world-class technologies. So I don't really have a problem with that. I also don't have a problem with the Magnificent Seven resting for a while and for some kind of regrouping where investors put more money in the S&P 493, which on a relative basis are cheaper, and they'll probably get a lot more benefit of AI than even the Magnificent Seven.
But you wouldn't see a reason to, avoid the S&P, kind of the classic, or to kind of double down on small caps or go international or whatever.
Well, I've been recommending an investment strategy of stay home as opposed to go global since 2010. I mean, at some point, I will probably overstay my welcome, but it just has worked for a very, very long period of time. As Brian said, Europe, at least on a short-term basis, has outperformed, but I think the trend is America continues to be a much more diversified, much stronger, much more resilient economy than most others, and I think that's what's reflected in the stock market.
I also just wanted to ask you, I thought it was interesting that you kind of talk about ignoring Washington. And this week, it feels like the market is ignoring Washington. We've had a myriad developments that you could say are cause for concern. And they're just kind of being shrugged off. And one thing people have said is, look, if they're trying to shrink the federal workforce or put more of those people into the more productive private sector, like that's the trend to focus on in the longer run. Is that how you come at this?
Absolutely, and it's consistent with the idea that pay attention to the economy itself. Look how it's the headlines. With all due respect to what you do and what I do, we tend to focus on the macroeconomic policies, monetary policy, fiscal policy. Just spent a couple of hours watching the Fed chair in Congress. But the reality is the rest of us working stiffs are doing an amazing job of keeping the economy going despite Washington. And so, yeah, my conclusion is that, first of all, when it comes to investing, don't let your politics get in the way. The market goes up and has done well, whether it's Democrats or Republicans. And again, I think it's because the stock market, the private economy, the private sector continues to perform extremely well despite Washington. And I think that's an important thing to consider when you're investing.
All right. Ed Yardeni looking ahead to the Roaring 30s.